Hi everyone, my name's PK and here I have Luke Vasquez. This is a completely different type of episode. We're going to be exposing property lies. There's thousands of buyers agents, I'm sure dozens of course creators, including myself. And like so many people just share lies that somehow have been entrenched in property industry for newcomers, new people that are investing in property that just accept these lies for what they're worth. But we're here to expose them using data. And the person who's really done this is one of the people is Luke Vasquez, who's a university student, and he hasn't even bought a property yet. So it's like, why should I listen to him? It's because he's probably done more research than people who've already bought 5 properties, because he really wants to make sure he doesn't get that first property wrong. The first property is the most important property, and a lot of what we'll be taking is actually from, and I'll give credit to where credit is due, Jeremy Shepherd, okay, who's really big on data. You can go look him up. I encourage you to do that, but all the credit goes to him. That's where the data comes from. Luke, is there anything you wanted to say before we get into it?
No, I just really giving credit to Jeremy for his work. I think he's done a really good job at really educating the community about property and sort of challenging some of those sort of old wives' tales that have existed in the property community for a long period of time, I think.
Let's go through chart by chart. So, guys, I have 22 charts. So there's a lot of stuff to cover, and it's every chart's going to like maybe blow your mind or something like that. So stay with us. We're going to go through each and every chart. Here's the first one. I'll zoom in a little bit. So what this is saying is 10 biggest significant urban areas versus 10 smallest. Luke, like, how do you interpret this?
Well, I think the biggest thing for me here is just looking at the end result. It's obviously a cumulative growth graph over the time, and you can see remarkably after 30 years, both the 10 largest significant urban areas and smallest have both returned with 638% capital growth, which is pretty remarkable. We often hear, you've got to be in the big urban areas, the big cities, stay away from the regionals, they don't perform as strongly, less employment. But, that's just not the reality. Because if it was, you would see a continual outperformance. But unfortunately, after 30 years, we see that they perform exactly the same, which, probably goes to show the growth ripple effect really takes place everywhere.
Yeah, and this is not like a 10-year chart. It's not we've just cherry picked some amazing, performance time frame for regional property. Like I've seen another chart where Launceston has performed just as well as Sydney over a period of time. But, for those of you who think Sydney, Melbourne, no offense, but, Sydney and Melbourne do not outperform the rest of Australia over a considerable period of time. And this goes all the way back out to 1990. Okay, next chart. So this is saying 1991 census income versus 20-year growth. What is this? What does this one mean, Luke?
Well, basically, we're having a look at the 1991 census, having a look at the top suburbs on incomes, which is basically your blue chips. In Melbourne, that might be your Toorak and your Brightons. In Sydney, it might be, your Vaucluses, your Point Pipers, etc. And basically having a look to see whether those suburbs can outperform over the next 28 years. And unfortunately, the graph just shows that it's basically there's no correlation between income and long-term capital growth. The graph clearly shows from the first decile to the last, there's a pretty statistically insignificant difference between all the deciles, which really just shows that it doesn't matter what sort of income level the suburb you're buying into is, you're going to do fine either way. There's no correlation here. It's not something that's actually relevant in any way, despite many of the experts talking about got to invest in areas with high incomes.
Yeah. I mean, there's a really, really famous podcast out there, and the guys always go on about how you need to buy blue chip property and it needs to be in nice green leafy streets and the amazing owner occupier appeal because everyone drives an Audi. It's those areas that perform the best. It's not true. If actually anything, this is not statistically significant, it's not really material, but it seems that people in the middle, kind of like middle income earners, that sort of suburb or those suburbs tend to perform a little bit better, as you can see in decile 4, but yeah, really it's insignificant. So guys, if you're, stretching yourself to buy an expensive property, it's going to be hugely negatively geared just because it's a better suburb, quote unquote, like that's probably not the right way to go about investing. All right, next one. Suburb property price variability. What is this one?
Well, essentially, you often hear in property circles, you've got to invest in the good pockets of the good of the suburbs. We invest in the good properties in the suburb. There's certain properties in certain pockets of suburbs that will outperform others. You want to be away from the public housing areas. You want to be in the good parts of the suburb because those are the areas that will continually outperform the other parts. And basically, if this phenomenon was true in a general sense, what you would see over time is the suburb price variability would increase because the percentage difference between good properties and bad properties, or good pockets and bad pockets, would expand over time. But the reality shows this hasn't happened at all. It's, if anything, it's actually gone the other way. It looks like price variability has shrunk, which suggests that the difference between those bad properties and the good properties in suburbs has declined over the 25, 30-year period that we've got here. So that really debunks that myth, I think, as well.
Yeah. And of course, that doesn't mean that we should just aim to buy in the most dodgiest pocket of a suburb. There's other factors to consider, like what kind of tenants it's going to attract, how easy it will be to maintain, and other things like that. But just from a pure capital growth perspective, it doesn't matter as much as people might make it out to. As you can see, as Luke said, this deviation from the median has actually gone downwards. So if anything, it meant a lot before finding the best street, the best property. It still is important, don't get me wrong, but not as important as people might have you believe. All right, next one here. This is a little bit convoluted. Growth 2001 to 2011 versus growth 2011 to 2021. What do we take away from this one?
Well, basically, you often hear experts say, proven track record of performance. You've got to invest in areas that have a proven track record. Unfortunately, that just basically theory is just not true. They are right in the sense that, past performance does have a correlation with future performance, but it's in the opposite direction they claim. An area that's outperformed in the recent past is more likely to underperform in the near future. And that really just showed here. There's a clear correlation with the overlaps. So you have Brisbane outperformed the most between 2001 and 2011. All of a sudden, it's the third worst performer there. Central Coast, worst performer in 2001, 2011, the top performer in 2011, 2021. Same with Sydney, same with Perth. You can see that the overlaps are very significant here. It's pretty clear over time. Things just generally even out to that sort of 6 to 7% range over time. So, yeah.
And what kind of strikes me is, once again, the age-old question of like, does Sydney, Melbourne always outperform, the big job centers? That's where all the immigration comes in. But, after the Olympics, this is after the Olympics, like this big event that put Sydney on the map. Sydney for the next 10 years after U2000 underperformed. That was the second worst. Like, that's just phenomenal kind of insight. And the trend is very clear, right? So I would kind of imagine going forward, of course, there's more to it than this, but I'd imagine that the three best performers in the next 10 years from 2021 onwards was, according to this at least, is likely to be Brisbane, Adelaide, and Perth. Lo and behold, those are the cheapest areas with the highest yields, areas that, of course, people have been following me know that I've been talking about for a long, long time. So I mean, no one talks about this. I don't know why they say that, something that's performed in the past has a proven record that's going to perform in the future. Smells like BS. All right, this next one, something that actually surprised me as well, growth versus renter percentage based on the census from a long period of time, 2006 to 2018. What is this telling us, Luke?
Basically, here we're just looking at the percentage of renters in a given suburb, and we're seeing if suburbs have more renters, outperform or underperform over a long period of time. Obviously, people often talk about owner-occupier appeal, and here that looks like that actually is pretty true. Looks like over time, the less renters you have in a given suburb, the more likely they are to outperform.
Yeah. And one thing I'll add is, like, normally from my experience, those areas that have renter percentage less than 10 or maybe even 15 tend to be quote unquote blue chip suburbs. Not in all cases, like there's always exceptions to that rule. And those are heavily, heavily negatively geared. So that is one case for buying in, like, owner occupied blue chip areas. But, you can still find many, many suburbs with, if you draw a line somewhere, like let's say 20 or 30 or 35, you can find affordable, high owner occupier locations that grow really well. But yeah, guys, be very careful of like a place like Woodridge, right? Woodridge and Logan Central, a lot of buyers agents get you in there. I think the renter percentage is like 70 or 75. So in the short term, it's performed really well, but over the long term, remember, this is a long-term view, it kind of sucks. So be very, very careful of that. All right, next suburb, Sydney land values or valuations, I assume, versus kilometers from the CBD. It's kind of self-explanatory, but Luke, go ahead.
Well, basically, we're just investigating the claim that proximity to the CBD is a growth driver. I often hear people say you've got to be in the first 10K, 20K from the big CBDs. They outperform over the long term. Um, and we're using land values here to avoid the whole median price trap. So we're not using median data, which can be skewed. We're using land values, which is natural capital growth, and we're just going to see if there's any correlation. And the graph shows that over the 17-year period, there's basically no correlation at all. The line of best fits perfectly flat. There's no difference whether you're buying 60 kilometers from the CBD or 5Ks. It's pretty much exactly the same. The idea that land values would have, or the idea that kilometers from the CBD has a correlation with long-term capital growth is a pretty flawed theory.
Yeah, and there's once again, and not to point out any names, but it's really tempting to do so. There's many buyers agents out there, especially some who espouse the need to buy, multi-million-dollar properties because that's how the top 1% of Australians invest and get rich. And you should buy in Vaucluse or these types of areas. I mean, this graph completely negates that argument that you need to buy expensive and premium close to CBD locations to get that premium growth. Simply not true. And I don't know if we have further charts on this, but this is actually by and large, this kind of flat horizontal line is true for basically all of our locations across Australia. So it's not just a Sydney phenomenon. And then a similar thing, proximity to stations. I assume this means, is it train stations or bus stops?
Train stations.
Yeah. So what's this one saying?
Basically, just looking at whether being close to train stations, results in any sort of outperformance at a suburb level. Basically, do stations with suburbs outperform those that don't over the long term? And obviously, here we're seeing it doesn't. There's numerous sort of intersection points throughout the graph, which clearly shows that there's nothing really going on here. It's over the 30 years, we're not seeing any significant difference between the two lines at all. So there's basically no correlation between suburbs and stations versus those that don't.
Yeah, yeah. So, I mean, it's sort of really counterintuitive and hard for me to believe, but this is the data. Like the data is just cold, hard facts. Once again, we do, from a rentability perspective, it's, if you had the choice, you'd want to be close to those amenities. You want to be close to a train station, even to buy a property for investment purposes. If you had an identical scenario and one property was closer to a train station, like who wouldn't take it closer as long as everything else was exactly the same? But that's not a factor that you would prioritize over anything else according to this chart, which is very clearly laid out. All right, this is a really, really common one, growth Melbourne suburb. So Melbourne suburb growth over this time period from 1990 to 2018 with classic schools versus those without. I assume classic schools means like really well-rated schools or private schools, something like that.
Yeah, they're basically long-established schools that have, high desirability. Been there for a long period of time, very desirable. Both public and private. There's numerous public schools as well. They're in that same caliber, but again, same thing. There's no real correlation here at all between having good schools in the same suburb and those suburbs outperforming versus suburbs that have average schools.
It's sort of interesting that this purple line, it does divert and decouple from the green line, the non-good school suburb growth line for a period. It happens here as well around the GFC time, 2007, 2008. I don't know the reason for that. Maybe there's some arbitrage opportunity. A new school coming in is likely to, really boost land valuations in a suburb. I don't know if that's the reason, or of course, this is such aggregate data, probably smooths all those exceptions out. But over the long term, there's no difference. So once again, guys, if everything is equal, you probably want to choose something close to a good school, but it's not something that I would prioritize and pay extra for or something like that from a growth perspective. This is awesome. I'm having fun. Suburbs near shopping centers. So, we've covered stations, we've covered proximity to CBD. Does being close to a shopping center actually help capital growth?
Yeah, pretty similar chart here again. Doesn't look like there's much in it here at all. The graph's been following a pretty similar trend the whole time. Looks like there's a little bit of a divergence of 2012, but looks like they're going to converge again in the recent future. Again, that gap's been shrinking. So the fact that there's convergent points suggests that there's no correlation here. If there was a correlation between shopping centres and capital growth, you would see the purple line and the green line expanding consistently over time, like you can with other trends such as units and houses. But this just isn't one of those trends.
Yeah, I'd love to see like another line to show the collinearity or just the relationship between rental growth and some of these factors that we've been mentioning, because there's no, significant relationship with capital growth. But my hypothesis is that there could be something with rental growth, but I don't know. But at least not from a capital growth perspective. Okay, 8-year capital growth following a 20-year. What does this one mean?
Income growth. So
income growth.
basically, one of the claims is invest in areas of higher incomes, but there's a second part to that as well. Some experts go a bit further and say it's not about income, it's about income growth, because that suggests gentrification. Nonetheless, we've had a look here at the 8 years capital growth following the 20 years of the suburbs with the highest income growth over a 20-year period, and seeing whether we're seeing any sort of outperformance here. And the data actually shows the exact opposite. Areas with the less income growth are actually growing at a faster rate, for whatever reason that may be. But either way, it's another myth busted. There's no correlation between income growth either, as well as incomes in terms of long-term capital growth performance.
Right. So decile 0 is the lowest income levels and D9 is the highest. Is that right?
Yeah, I think it's actually maybe because of the fact that the areas with the highest income growth, not necessarily people getting pay rises. I think that these are the areas that have gentrified the most in the previous 20 years already. A lot of people have moved into that suburb. It's pushed prices up higher. The high prices have then meant only rich people can get into it. That's pushed the income growth, the income up. It looks like it's income growth. But I think these are just the areas that have outperformed over the past 20 years. And then I think that's why they've underperformed over the following 8 years, just because they've outperformed over the past 20 years.
Yeah, I think there's some sort of regression to the mean kind of variable going on in here, because like if I just take a suburb, it's very hard to get true data. It'd be great to have a chat with Jeremy as well to kind of deep dive a little bit further. But let's say like Redfern. Redfern's in Sydney. It's quite close to the airport, quite close to the CBD. And, it was like a commercial, industrial, I don't want to say trashy, but not the greatest area. And it's literally like more than tripled in the last 10 years. But what were the incomes before that? It's hard to tell because it wasn't fully zoned residential. So I don't know if it's like, if the data has some, like how statistically reliable this data is. But I mean, if it is even close to being true, then it gives a pretty clear picture of what's going on. Okay, next one, yield versus decile distance from the CBD. Go ahead, Luke.
Yeah, here we're just basically looking at the rental yields in terms of the distance from the CBD. This one here, pretty clear correlation, pretty clear trend. The further away you get, the higher rental yield you get.
Yeah. This one's pretty obvious, and we've already demonstrated as well, not we, but Jeremy has demonstrated that being close to the CBD has no additional capital growth over the long run. So when you look at a place like a chart like this, it's so easy to conclude, and as you should, that you don't need to buy close to the CBD. In fact, if you do, you're going to buy something heavily negatively geared and it's going to underperform in terms of capital growth. Just the opposite of what, I wish I could say names, but just the opposite of what like some of the biggest property institutions or buyer's agents in Australia will tell you. So actually, according to this and that previous chart, it's probably better to buy in ring 7, ring 8, ring 9, because you're getting the most high yield, or at least high cash flow, positive cash flow. Ideally, it helps you ride through the interest rate cycle and you get just as good capital growth. So that's, yeah, these economics of property are seldom understood, and it's really cool to go through these charts. This one's a bit different. What does this one say?
Since looking at the long-term cumulative growth of all the major cities, the idea that some cities outperform others, clearly it's just sort of moved by this theory over time. In the short term, there's differences, but over the long term, it all kind of averages out. A bit of mean reversion happening here as well.
Yeah. And I think some people might ask, oh, hey, why have you guys taken an arbitrary end in 2017? Because obviously Sydney has boomed after that. And some previous charts we were taking in 2018. That's just when I think this analysis had been conducted by Jeremy. But even if you had that school of thought, yes, Sydney has gone up again, no doubt about that. but so is Brisbane, so is Perth, and so is Melbourne. In fact, over the last couple of years, Brisbane has outperformed Sydney and Melbourne. I think Adelaide has as well. So once again, if you're kind of living in Sydney, Melbourne, and you're like, you know what, I just want to buy in these areas because that's what's safe. It's safe. It's actually not any more safer than buying in any other capital city or any other major regional center for that matter. Okay, we've got a few more. What is this? Is a table. What is this one saying?
This one's just looking at sort of each the price point of each suburb representing 10 different deciles, and then whether they go on to outperform. So it looks, the idea of blue chip outperforming, is it true? And over time, you can see that it's actually not true at all. The 10th decile over time has actually underperformed the first decile, and there's a pretty clear correlation between the decile and capital growth. The cheaper you go, the more they outperform over the long term and short term for that matter as well, actually.
Yeah. So D1 is cheaper, D10 is more expensive, and you see after a 3-year period, 12% beats 5%. I hope I'm reading this right. 4-year period, 11% beats 5.8%. 5-year period, 10% beats 6%. So, guys, there's no reason. I mean, when I did the analysis, I came to the conclusion there's no need to buy residential property for investment purposes above 700K. In fact, the cheaper is not necessarily the better, but there's just no reason to go above that. Ideally, between 400-500K, a little bit less, a little bit more. That's sort of the sweet spot. Value versus yield. What does this one talk about here, Luke?
Instead of the other chart where we looked at yield versus proximity CBD, here we're just looking at the price points and yield, and we're seeing the cheaper the price point is, the higher the rental yield is. That's been consistent over time, though the yield has gradually dropped as prices have been increasing over time. The general trend that the cheaper you go, the higher the yield has been consistent.
Nice. Okay, so that's obvious. Historical growth versus future growth. We sort of touched on this before, but it suggests that in the blue, the last 10 years is kind of going like this, and the next 10 years is like this. So this really perfectly illustrates that law of averages or regression to the mean. If something has already grown in the last 10 years, it's fairly unlikely it's going to be an outperformer in terms of growth in the next 10 years. So when you're looking for your next city, or ideally just suburb within an LGA, try to find something that hasn't grown that much in the past and that does have strong data right now, because we want to get those short-term growth. We want to be able to leverage equity, in the next 1 year, 2 years. Over the long term, 30 years, everything performs the same anyway. So property investing is a long-term game, but to retire or to get a passive income, we need those short-term results. Kind of counterintuitive, but that's the way to understand it. This was an interesting one by Jeremy. 16-year capital growth probabilities. How do we understand this one, Luke?
Well, here we're kind of investigating the claim that most property markets perform the same over the long term, and we're just having a look here whether there's any sort of decent chance of outperforming or underperforming. And here we're seeing that for the most part, most suburbs perform generally within a pretty similar sort of that 5 to 10% area. There's very few suburbs that continually perform that 10 to 15% over a long period of time, and even fewer that underperform. So, yeah.
Yeah, and this is kind of comforting as well, because it is a normal distribution curve. And in this 16-year period, we had the GFC and other crises like that. So, despite what happens in the short term and the long term, it does come through. Of course, if you buy a dud, even over 16 years, you can lose money under 5% or 5 to 0%. If you do average, then, you're looking at about 7.5% according to this chart over the long term. And then 2-year capital growth probabilities, this kind of juxtaposed versus the chart that we just saw, to me anyway, it suggests that there's much more diversion or diversity in outcomes. And that what do you make of this being kind of skewed to the right here? Luke, is that saying that it's actually easier to make money or more likely to make money in the short term?
Yeah, I think the point is that over the long term, there's very little difference between suburbs, but in the short term, you can get radical differences. There's much more chance of outperforming. There's, much more divergence in general, so more opportunities to make money in the short term than there is in the long term. In the long term, it all kind of averages out, but in the short term, it's quite easy to find those outperformers.
Yeah, so well said. Thank you. Growth versus distance to CBD. I think we already covered this. Is this the same chart, or has this got some nuance?
This is a similar one, but looks at median values as opposed to land values. This one, again, shows a pretty similar trend. If anything, it's probably not as statistically reliable because median value is a bit more flawed than land value. So I'd give more weight to the other graph.
Got it. Got it. Similar insight or takeaway, though. Government housing versus capital growth. Just take us through this one.
So he was looking at the claim that, excess amounts of government housing in the suburb affect, capital growth over the long term, medium term. And here we're having a look and seeing that it's actually been, there's not much in it really. Over the long term, doesn't look like, excess amounts of government housing have really made any material effect on, capital growth. It seems as if, the fact that there's government housing in the suburb would be already priced into the market, and therefore it's just going along with the averages.
Yeah. So there is a very slight decline here, which suggests that maybe slightly around the edges, if there's some horrendous clusters of public housing with like terrible sort of street appeal, that might, just might have some impact on capital growth. But largely, if you kind of ignore beyond 10%, which you shouldn't really be. Yeah, there's not many suburbs with government housing beyond 10 or 15%, then there's no real implication. Of course, once again, the rental market is different, just like the brand new market for cars is different from the secondary market for cars, right? Different price points, different things that people look for, different type of demographic. Same with this. To buy and sell a house is a different market. To rent a house is a different market. And, oftentimes renters don't want to be next to some trashy government house. Not that they're all like that, but from a strictly capital growth perspective, it doesn't matter. And then 32-year growth possibility. So we talked about 2-year growth possibilities or probabilities. I think was it 18 years or 16 years? We talked about one of them. This is stretching that out even further to 32 years. I mean, you can't really get data that's robust, beyond, this time frame in a lot of cases. So this is as far as we can go. And once again, over the long term, everything basically does the same. In Australia, in this 32-year period, we've had things like the recession we had to have in the late 80s, early 90s. We've had oil crises. We've had all sorts of things, and properties perform well. So don't stress, even if you get it dramatically wrong in the short term because you've thrown a dart at the map. It will still come right in the long term. But of course, that's not going to let you leave the 9 to 5 in 32 years because you would have just made this much money in one property. You need that short-term growth, like Luke was saying a few times. Okay, second to last chart, promise. Past growth, i.e. 20 years versus future growth. How do we understand this one?
Basically, just looking at the correlation between past growth and future growth. And on this graph, the general trend line is showing, the same thing again. The more a suburb outperforms in the short term, the more likely it is to underperform in the recent future, and vice versa as well. So the idea that targeting, those suburbs that have already grown heaps is going to result in outperformance is truly a flawed theory by this data.
Yeah, this is actually really interesting. In my course, I teach this exact same concept more around the 10-year time period. But if we extrapolate or stretch that out, then the same theory exists. We want to find suburbs that have languished for a long, long period of time. That doesn't mean we just automatically invest in them. The stars needs to line up, the data needs to be good now, but we do want to find those ugly ducklings or black sheep, so to speak. And this is a slight deviation on that, which is saying past 10 years versus future 20 years. So before we looked at 20 years, and 10 years, 10 years. This is 10 years and 20 years. And the gradient is a little bit less here, but same principle applies. If something is languished, suburb has underperformed, maybe it's been negative or under 7%, which is the Australian average for the last 10 years, good chance that in the next 20 years, not just 10 years, but in the future 20 years, because we want to buy a property, we want to hold it almost forever, right? For most cases, it's going to do well. So this has been really, really insightful, this 22 charts that we've just gone through. Luke, just before we wrap up, once again, to reiterate, I think you've done so much research. You've probably had calls with lots of companies. You've been in all the Facebook groups, probably watched a lot of YouTube content, podcast content. what's your like best advice to people just like you? I mean, you haven't signed up to my course, you've not signed up to a buyer's agent, you've not paid, I assume, for anything yet. You've just done a lot of diverse free research. What's your best advice to people who are maybe just like you, whether they're 21 or 41 or 51, but they haven't bought a property and they're like, everyone's trying to sell me stuff. What should I do? What's your advice to those people?
I think the real key thing to do is just challenge everything that you read here. Don't just blindly believe anyone, trust anyone. Really look into things, dig a bit deeper, be skeptical, and you'll start seeing, look where the data's going. I think the main thing to do in property is really just challenge everything you're reading, everything you're hearing, everything you're seeing, because things are not quite as they seem always. A lot of people are agenda driven. So just making sure you're really following the data, not listening to too many opinions, just following the data. Because the thing with property is you're going to see so many different opinions. So just make sure you're following the data. And I think if you follow the data, you really can't wrong.
Yeah, 100%. I just want to finish off. This is quote that I recently heard, and it's really poignant. It says that 10% of people in the world think, 20% of people in the world think they think, and 70% or the balance of people rather die than think. So, obviously you don't want to be in that 70%, but you like most people that are probably watching this, or maybe not my audience, hopefully, but watching content and absorbing podcasts and stuff, they're in that 20% category. They're thinking because they're learning, they're hearing, they're watching the experts. That is a surefire way to make huge, tremendous errors. You have to be in that 10% who actually think, not just regurgitate recycled information you've heard elsewhere, but be like Luke, actually think and challenge everything, including me, like challenge your own mindset as well. But yeah, this is really cool. Like I said, guys, at the start, I'm not paying Luke to be here. He was just like a really good contributor in my Facebook group and was challenging everything, including me. So I thought, why not have him on? And he brought these amazing charts from Jeremy Shepherd. So yeah, thank you so much, Luke. Big gratitude to you.
Thanks, PK.
All right, see you guys. Subscribe below. I'll see you next time.